How to avoid capital gains tax on real estate. Hey there, it's Tony Puppet. Before we jump in, make sure to hit that like button and subscribe to my channel for more real estate tips that can help you keep more money in your pocket. Today, we're diving into a critical topic: how to avoid capital gains tax on real estate. If you've sold or are thinking of selling a property, you've probably heard about capital gains taxes. They can eat up a big chunk of your profits, sometimes as high as 37%. But here's the good news: there are strategies you can use to avoid or minimize these taxes, and I'm here to walk you through them. What is capital gains tax? First, let's break it down. Capital gains taxes are taxes on the profit you make when selling a property. The profit is calculated as the difference between what you originally paid for the property and the amount you sell it for. The IRS requires you to pay capital gains taxes when you sell real estate, whether it's a second home, rental property, or vacation home. Now, if you're selling your primary residence, you may already qualify for exemptions that can drastically reduce or even eliminate your capital gains tax. Let's get into how you can reduce these taxes, whether you're selling an investment property or your primary residence. 1. Primary residence exclusion. If you're selling your primary residence, you could qualify for a significant tax break. The IRS offers a $250,000 exemption for single taxpayers and a $500,000 exemption for married couples. To qualify, you need to have lived in the home for at least 2 out of the last 5 years before selling. The good news? These 2 years don't need to be consecutive. You just need to have lived there for a total of 2 years within the last 5. This is one of the easiest ways to avoid paying capital gains taxes, so if you're thinking of selling your home, make sure you meet the requirements to take advantage of this huge benefit. 2. 1031 exchange for investment properties. For those selling investment properties, a powerful strategy is to use a 1031 exchange. This allows you to defer paying capital gains taxes by reinvesting the profits into a similar type of property. You have to meet specific requirements, like reinvesting the proceeds into another property within 180 days, and the new property has to be of like kind. This means it must be another real estate investment property. While this doesn't eliminate the taxes, it defers them, allowing you to keep your profits working for you in a new investment. 3. Wait for long-term capital gains. If you can afford to hold on to your property for a bit longer, it could save you money. Selling a property that you've owned for more than a year qualifies you for long-term capital gains tax, which is significantly lower than short-term rates. Short-term gains, properties sold within a year, are taxed at your regular income tax rate, which can be much higher. By waiting at least a year before selling, you can reduce your tax liability. 4. Strategic timing. Another smart strategy is to time the sale of your property for a year when your income is lower. Why? The IRS bases your capital gains tax rate on your total income. If your income is below certain thresholds, you might pay a much lower rate on your gains, or even 0% if your income is low enough. This is especially useful if you're retired or expect to have a lower income in a future year. Selling during the low-income year can reduce your capital gains tax or even eliminate it. 5. Buy in opportunity zones. Investing in properties located in opportunity zones can also help you defer or even reduce your capital gains taxes. Opportunity zones are designated areas that could benefit from economic revitalization, and the government offers tax incentives to encourage investment in these areas. If you invest in an opportunity zone and hold the property for a certain period of time, you may be able to reduce or even eliminate your capital gains tax liability. 6. Itemize your expenses. Don't forget about itemizing your expenses when selling your property. Things like renovations, repairs, and selling costs, like agent fees, can reduce your overall capital gains by decreasing the amount of profit you're taxed on. The more legitimate expenses you can claim, the lower your taxable gains. 7. The 2 out of 5 year rule. If you're selling a home that you've lived in as your primary residence for at least 2 of the last 5 years, you could qualify for that $250,000 or $500,000 for married couples, exemption we talked about earlier. This rule is great because those 2 years don't need to be consecutive. As long as you've met the residency requirement, you're in a good position to avoid capital gains taxes on a large portion of your profits. What about reinvesting in real estate? A common question I get is whether you can avoid capital gains taxes by reinvesting the proceeds into another property. The answer? You can't avoid them entirely, but using tools like the 1031 exchange can help you defer those taxes. This means you're not off the hook for paying them, but you don't have to pay them right away, allowing you to reinvest your profits. Final thoughts. Capital gains taxes can seem like a big hit when you're selling real estate, but with the right strategy, you can minimize or even avoid them altogether. Whether it's using the primary residence exclusion, a 1031 exchange, or strategically timing your sale, there are plenty of options to keep more of your hard-earned profits in your pocket. If you have any questions or need help navigating your real estate sale, feel free to reach out. I've included a calendar link in the description below where you can book a no-obligation meeting with me. We can discuss your specific situation, whether you're selling a home or an investment property, and figure out the best way to minimize your tax liability. Thanks for watching, and don't forget to like and subscribe for more real estate tips. See you next time.